Through the second quarter of the year, 210 of the nation's 413 largest regional housing markets fell into the significantly overvalued camp. That's like half of them. According to Wall Street, the U.S. housing market is poised to see the second biggest home price decline since the Great Depression. It happened in the 80s and again in the early 90s. Most people alive remember the 2008 market crash, which is the last time it occurred. National home price declines are uncommon, and sharp declines in value are rare. Only the Great Depression and the Great Recession saw nationwide home prices fall in the double digits range. There isn't a lot of data on this subject because historically speaking, real estate has been a safe investment. Remember, it only occurred in the early 80s, the 90s, and the worst decline in recent history was 14 years ago, back in 2008. This lack of history is why the predictions of several Wall Street titans are raising eyebrows. Just how far will home values decline? How soon can we expect to see a decrease in property values? Answers to these questions starting right now. Welcome to Ask the Lender. This is your go-to spot for all things housing, money, and finance related. People tune into this channel to stay up to date on the housing market, as well as on how to pay less money in taxes, steps to getting the lowest mortgage rate available, plus proven strategies to save and grow money. If you find this channel helpful, please subscribe and click that bell right there to get notified. And when you subscribe, hey, like this video and share a comment below so I know that you are watching. This helps the YouTube algorithm place us in front of more people like you searching for helpful information. Recently, some of the titans of Wall Street shared their predictions on what will happen to home values as we move into 2023. Keep in mind that these predictions are a national average and will vary by area. Smaller and more rural areas may experience a different drop than larger metropolitan areas like LA, Washington, D.C., New York, and so on. Make sure to stick around to the end where I reveal just how far these Wall Street experts predict home prices to fall. So let's jump right in and take a look at where financial giants expect U.S. home prices to head next. Last week, Morgan Stanley finally joined the housing bear crowd. Heading forward, the investment bank now expects U.S. home prices to fall by 7% by the end of 2023. And on one hand, that's far smaller than the 27% peak-to-trough decline the company experienced between 2006 and 2012. On the other hand, it's twice as large as the 3.1% peak-to-trough decline posted in the early 90s. In fact, if Morgan Stanley's forecast comes to fruition, it would mark the second sharpest drop since the Great Depression. What's to blame? Spiking mortgage rates coupled with unprecedented home price growth has put affordability into the highest levels of history. Morgan Stanley researchers state, and I quote, "If we assume a 7% mortgage rate, affordability looks materially worse than today, and the pace of its deceleration has already more than doubled compared to almost any time in history." The positive takeaway, which we think puts this magnitude of 7% forecasted home price drop into perspective, is that this decrease would only bring home prices back to where they were in January of this year in 2022. And that's still 32% above where home prices were in March of 2020. Keep in mind that 7% decline is Morgan Stanley's base case forecast. The investment bank also issued a bull case and a bear case. If mortgage rates come back down to earth by next spring, which is Morgan Stanley's bull case, U.S. home prices could climb 5% in 2023. Conversely, if the country slips into a recession, which is Morgan Stanley's bear case, the national home price decline could exceed 10%. Do you feel we are headed into a recession? Everything I read says that we already are, so if that's the case, then we could see double-digit drops. In another statement, Morgan Stanley researchers say, and I quote again, "Affordability is already challenged, exposing would-be homeowners to an increasing rent environment that erodes their ability to save for a down payment. If that were to be combined with increasing unemployment, we could imagine a scenario in which existing home sales continue to outpace the global financial crisis of 2007 and 2009, end quote. As weakening housing data trickled in over the summer, Goldman Sachs maintained a positive home price outlook for 2023. Well, that was until they caved just last week. Top to bottom, Goldman Sachs now expect U.S. home prices to fall 5 to 10%. That's a sharp downward revision from last month when the investment bank predicted that U.S. home prices would rise 1.8%. Goldman Sachs researchers are on record saying, and I quote, "We view the risk to these estimates as tilted to the downside because of a sharp deterioration in our descriptive home price outlook scores and evidence of strong mean reversion in regional data." Personally, I find any prediction Goldman Sachs makes to be complete BS. But in full disclosure, I'm not a financial planner or advisor, and I do not play one on TV. I am, however, a hardworking data for a U.S. Navy veteran who is simply sharing helpful information along with my own opinion. I am a licensed loan originator, and the company I represent may have a complete different opinion than mine. Moving on. Good mortgage underwriting, plain vanilla lending, record low vacancy rate. That's why Moody's chief economist Mark Zandi says we aren't headed for a 2008-style housing crash. However, Zandi says improved lending practices and tight housing supply won't be enough to prevent the ongoing home price correction. The fundamentals, he says, are simply too detached from reality. Peak to trough, Moody's Analytics expects U.S. home prices to fall 5% to 10%, even if a recession doesn't come to pass. If the country does slip into an economic downturn, which, by the way, I think we already have back in April, May, it just won't be announced until after the November midterm elections. Moody's Analytics predicts U.S. home prices would fall by 10 to 15%. Either way, Moody's chief economist says it will likely take 12 to 18 months for prices to bottom out. Every quarter, Moody's Analytics assesses where local fundamentals, including local income levels, can support those local home values. If a regional housing market is overvalued by more than 25%, Moody's Analytics deems it significantly overvalued. Through the second quarter of the year, 210 of the nation's 413 largest regional housing markets fell into the significantly overvalued camp. That's like half of them. Heading forward, Moody's Analytics predicts significantly overvalued housing markets should see home price decline between 10 and 15%. If a recession hits, Moody's Analytics expects those home price declines to widen 20 to 25%. That's huge. In significantly overvalued housing markets. The truth is that these same Wall Street experts did not correctly predict where we are now. We are not in a 2007-2008 situation because the mortgage guidelines are much stricter than they were in 2008. It's not likely that we will see a ton of foreclosures unless something extreme happens. So if you or someone you know are looking to purchase or sell a home, let's chat. And if you haven't already, make sure to subscribe to that channel and smash that bell right there to get notified when more helpful content is posted. Check out the video below to see what the Fed is saying about their intended housing market reset. We'll see you next time on Ask the Lender.